Back in 2006, I invested a bit of my money in mutual funds that were really hot at that time in my country. Everybody was buying them, and there were so many stories about how much money people made with them. So I thought to myself, this gotta be good. Now, this is the result of these investments today. As you can see, in 18 years, I lost a big chunk of money. As you can imagine, I was devastated. All those savings going to dust. I swore I'm never investing again. But then I decided I'm going to take this disaster as a lesson. I started learning about investment, finished my CFA, and learned how to really invest money to grow wealth. I learned the hard way, unfortunately. It is really important to stick to the basic principles of investing if you want to use stock markets to generate returns. And these are the basic, from my experience, most important principles of investing. Invest for the long run. It is important to understand that the stock market is geared toward long-term investments, so the money you don't need for at least 5 years. Let me show you. This is the S&P stock market index since the 1927, not adjusted for inflation. So the historical average annual return is 10.13%, but the average return of the S&P 500 stock market index that we saw earlier isn't always average. What I want to say is that the 10% average return might be the average return over the years, but the returns in any given year are far away from that average. In fact, between 1926 and 2022, the S&P returns were in that average band of 8 to 12%, only 7 times. The rest of the time, they were much lower, or usually much higher than that. So volatility is the state of play in the stock market, and even more so in the crypto markets. So this is not a scheme to get rich quick. The power of investing really comes from consistent growth over time. So you need to aim to hold your investments for several years or even decades to weather market fluctuations and benefit from the compound interest. For shorter time frames, you want to stick to different investment vehicles, such as savings accounts or maybe money market funds, a couple of things I'm mentioning in my emergency fund video. And you'd of course expect to earn a lower return for that safety that you get. Okay, the second principle, diversification. It's the old wisdom of not putting all of your eggs into one basket. Spread your investments across different assets, also different companies and different asset classes, such as stock, bonds, real estate, and commodities. This helps to reduce risk if one asset performs poorly in a certain period of time, and the other one may compensate for that. The third basic principle is one that is most overlooked in my opinion, and it is minimizing cost. Investment fees banks and brokers may charge to you eat into your returns heavily over time. So look for low-cost index funds or ETFs instead of actively managed mutual funds with high expense ratios. Then it is really important to invest consistently. Even small amounts invested regularly can add up significantly over time thanks to the compound interest, and investing regularly also enables you to avoid the market timing trap. Instead of you trying to guess what is the perfect timing to invest a lump sum, it's a much wiser decision to invest a consistent amount of money at regular intervals, such as weekly, bi-weekly, monthly, or even quarterly. This approach, also called the dollar cost averaging, averages out the cost per share you pay because you are buying more when the prices are low and less when the prices are high. Over time, this strategy helps you to reduce risk of investing a large amount of money right before a market downturn. And market downturns always happen. Then, of course, don't repeat my mistake. Do your research. Educate yourself about different investment options and what they actually mean before you start investing. Understand the risks and potential rewards of each type of investment you are considering. This is where I failed with my first investment. And I almost missed out on the opportunity to grow my wealth because of that, because I got burned so heavily. I relied on the market hype instead of trying to really understand what is going on and seeing that what I'm investing in is really not a good decision. Finally, stay disciplined. Don't panic and sell your investment during the market downturns. Stick to your long-term plan and ride out the short-term volatility. Following these basic principles not only enabled me to compensate for the money I have lost with this first bad financial decision I have made, but also helped me build wealth over time. So for me, it's a no-brainer. If we are saving, we need to invest. Otherwise, we're just throwing money out the window. Now, I'm not saying that you have to become a stock market wizard, but there are simple ways to invest your money that can outpace inflation and actually grow your wealth over time. But the key is to get started. And if you want to learn how to get started with diversified, low-cost investing opportunities, even with small amounts, then you need to see this video right here somewhere where I talk about exactly that. I'll see you there. In the meantime, I'm cheering for you. Bye-bye.